last night, the president-elect announced a gigantic $1.9 trillion stimulus, all sorts of goodies. Exactly what Wall Street wanted. And what happened? Well, the averages rolled over. Dow losing 177 points, S&P backsliding 0.72%, and the Nasdaq falling 0.87%. A lot of faves way down. Now, if you're scratching your head about this, the explanation is surprisingly simple, people. When an event occurs and the market gets exactly what it wants, but nothing more, it's treated as a reason to sell, not to buy. Biden's stimulus bill merely met expectations. It didn't beat the stimulus whisper, so to speak. Plus, it sure didn't help that Wells Fargo, JP Morgan, and Citigroup all reported today, and their numbers were promptly panned, good and bad. If the big banks are in trouble, well, that's a real problem. But I think the market completely misjudged these results. JP Morgan and Citigroup both made a ton of money. Wells Fargo's doing better than we could have imagined a couple of years ago. Even as CEO Charlie Scharf sounded disappointment. I think he's lowballing, frankly. Let me put it this way. If the bank stocks hadn't run up going into earnings, I bet JP Morgan would have rallied a couple of bucks today. Citi might have gained a point, and Wells Fargo might have dropped less than a point. Instead, all three got slaughtered, and they're repealing earlier gains. My advice, why don't you wait 3 days, counting today, then buy the stock at JP Morgan, the best of breed, or Wells Fargo, the worst of breed that's going to be better. Remember, I love those C stories to get to B+. They'll be able to buy back a boatload of stock this year and raise their dividends substantially, which is exactly what the shareholder base really wants. You just need to be patient. Now, I know patience is in short supply everywhere, but that's what you must be if you're a bank investor. Now, with that cheery thought in mind, let's dive right into the game plan. Today, we heard from the traditional deposit banks. On Tuesday, we're going to hear from an investment bank called Goldman Sachs, which specializes in all sorts of transactions as well as wealth management. I'm betting the quarter will be a barn burner. I think they had a great trading month in December, but the numbers might not matter, judging by today's reception for the big money center banks. Plus, Goldman stock has been a juggernaut, up from 190 in November to 301 now. In other words, it's coming in hot. And I don't like hot when it comes to earnings season. Only a massive earnings beat based on both revenue growth and lower expenses can propel this stock to higher levels. A normal beat is not enough. Plus, we need a super-duper raised forecast in order for this stock to rally. Next up is Bank of America, which is much more of a deposit bank, like the three we heard from this morning. While the stock pulled back nearly 3% today, I think it will be hard-pressed to rally much after the quarter, even as we interviewed CEO Brian Moynihan not long ago, and he said business has been terrific. The stock's been straight up ever since then. Like Goldman Sachs, Bank of America's coming in smoking in the last couple of months. What surged from 24 to 33. Once again, when the expectations are this high, it's not enough to be good. You got to be great.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.